We're analyzing Roche, stock ticker RHHBY, to see if it's a great business on sale. To determine if Roche is a great business, we're using the Select 6 analysis. The more metrics it checks out on, the more likely it is to be a great business. Then we're calculating the intrinsic value of Roche and comparing it to the current market price to see if it's on sale. After, we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Roche for your portfolio. Before we get into these valuable metrics, let's understand Roche's stock performance. Roche's over-the-counter listing is trading for $38.15 per share. In the last year, their stock price is down 27.5%. In the last 5 years, Roche is compounding at a rate of 5.5% annually. In the last 10 years, their stock price is up about 16% overall. Going back prior to the global financial crisis, more than 18 years, Roche's stock price is compounding at 6% annually. The company pays out an above-average dividend yield of 2.1%. Their average dividend yield throughout this time frame is in addition to these compounded annual returns. Roche is trading just $3 above their 52-week low. The company is down about $14 from their 52-week high. Roche is a large business. They have a 221 Swiss franc market cap. When converted to USD, is around 247 billion US dollars. Learning more, Roche is a Swiss biopharmaceutical and diagnostics company. The firm's best-selling pharmaceutical products include a variety of oncology therapies from acquired partner Genentech, and its diagnostic group was bolstered by the acquisition of Ventana in 2008. Oncology products account for about 50% of pharmaceutical sales, and centralized and point-of-care diagnostics for more than half of diagnostics-related sales. Roche Holding AG was founded in 1896 and is headquartered in Basel, Switzerland. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. Roche has earned significantly above average returns on capital in all 5 of these years. The reason we're looking for this benchmark is because the average publicly listed business earns about a 7% return on capital, and over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, with these business returns being captured here by return on capital. We can build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In these 5 years, while their returns on capital have trended down just slightly, Roche is averaging a 36.5% return on capital. That's massively above the benchmark we were looking for. That's nearly 5 times better than a typical business. This is a strong check starting things off for Roche. Metric number 2, we're taking a high-level look at their growth. We want to see growth in revenues, net incomes, and free cash flows in the last 5 years. This metric is all or nothing. All 3 of these have to be up for this to be a check. During this time, Roche has grown their revenues by 18%. Their net incomes have grown by 26%. However, their free cash flows are just very slightly down by about $20 million off of a base of more than 16 billion US dollars. That's a very slight decline, but that's a decline nonetheless. This is an X on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years for Roche. So we're looking at the company from the perspective of an individual shareholder in the business. Not only has Roche increased their net incomes by 26% in this time, the company has also bought back about 6% of their shares outstanding. Because of this growth in their earnings and their share buybacks, this has led to strong earnings per share growth that's outpaced both of these for Roche, meaning this is a check on metric number 3. Metric number 4, we're looking for free cash flow per share growth for Roche. Even though their free cash flows are marginally down over this time, because of their 6% share buybacks, these share buybacks are outpacing their declines in their free cash flow, meaning that Roche is actually growing their free cash flows on a per share basis here. This is a check on metric number 4. Recapping where we stand currently, Roche has 3 checks and only 1 X through our first 4 metrics. There's still one vital piece missing. You might think that nailing high returns on capital and having strong growth is the key, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt. Metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced in their last 5 years. We don't want to invest in overly levered businesses. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. While Roche has increased their net debt position over this time. Currently, they have $18 billion in net debt. The company has produced a massive $88 billion worth of free cash flow. That's dramatically above their net debt position, meaning this is a check here on metric number 5. Roche is strongly cash flow generative relative to the debt that they're employing. They'd be able to pay off all of their net debt with just over 1 year's worth of their free cash flows. This is very strong cash generation for Roche. Again, with a check here on metric number 5, we have 4 checks through our first 5 metrics. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide us with a slight risk premium to the yield of the 10-year treasury, and it may offer a potential starting point for a fair value of Roche. Roche has just under a $268 billion total enterprise value. This number takes into account both their market cap and their net debt position, so it gives us a perspective of the economic reality of Roche's business that's more similar to as if Roche were a private company. We learned in our previous metric, Roche has produced $88 billion in free cash flow in the last 5 years. This means in an average year, Roche produces about $17.6 billion worth of free cash flow. When we divide their $17.6 billion of their average free cash flow by their nearly $268 billion total enterprise value, that gives us about a 6.6% average free cash flow to enterprise value yield for Roche. On a current basis, Roche has produced $16.2 billion of free cash flow in their most recent fiscal year. When we divide that by their $268 billion total enterprise value, that gives us about a 6% current free cash flow to enterprise value yield for Roche. On both a current and an average basis here, this is coming in above that 5% risk premium, meaning this is a check on metric number 6. Just because this is the case doesn't mean you run out and go buy the business. This is not financial advice, and it's not a buy or sell recommendation of any security. You'll want to stick around as we perform our discounted cash flow analysis to come to a more concrete estimate of their intrinsic fair value before giving our final rating to the business. Before we can get to that, we can't forget about our bonus metric. As our bonus, we're looking at Roche's dividend profile. Roche pays out an above average 2.1% dividend yield. However, people make mistakes all the time by blindly chasing dividends. It's important to look at the fundamentals of a business to figure out if their dividend is supported or not. We want Roche to be supporting their dividends using their cash flows. That's been the case in all 5 of these years. Roche has steadily grown their dividend payouts on top of repurchasing their shares, and Roche has increased their cash flows per share again through some of these share repurchases. It looks like in most of these years that Roche has maintained a pretty modest dividend payout ratio, even though they have taken on more debt. It looks like their debt loads are strongly supported by their free cash flows. Roche has both been able to support their debt and their dividends in all 5 of these last years. Keep in mind that this is a snapshot of their last 5 years of performance, and it's no guarantee for the future. It seems like Roche's dividend is in healthy shape here. As promised, everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Roche. This takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Roche. A discounted cash flow model is based off the predictability of a company's free cash flows. Roche has tended to be a somewhat predictable business in its past. That's not a guarantee going forward for the company, but that does inform these assumptions. A discounted cash flow model is just like any other model in any other discipline. Its outputs will be sensitive to its inputs. Because we're looking at Roche's over-the-counter listing, their free cash flows on a per-share basis are going to be a little different here between Guru Focus and Ticker. We're taking their current free cash flows and using historical growth assumptions to project these into the future. It's up to you to do your own homework to figure out whether these assumptions are accurate and applicable going forward for Roche. If we assume that they grow their free cash flows at a rate of 4% annually for the next 10 years, then in the 10 years from there, that these free cash flows grow at 3% annually, adding in their tangible book value, which gives us an estimate of their tangible net worth, which could be understated due to the accounting for their share buybacks, so that's something you want to be mindful of. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for his investments, in addition to his margin of safety requirements, it looks like at today's valuations that a potential fair intrinsic value for Roche is just about $23 per share. There are some factors to keep in mind in addition to what we've already touched on. Roche's stock has dramatically underperformed this 15% rate of return throughout multiple decades in their past. This is part of the reason this is so dramatically down from their current stock price. Also, their 2.1% dividend yield would be included in this 15% rate of return. We would not be doubly counting their dividends. The most important thing to be aware of, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with your financial advisor. In just a minute, we'll talk about our final rating for Roche, but we have to address something first. What are the qualitative aspects of this business? Starting with the qualitative factors supporting a potential long thesis for Roche, number 1, collaboration between its diagnostics and drug development groups give Roche a unique in-house angle on personalized medicine. Number 2, hemophilia drugs Hemlibra and MS drug Ocrevus have multi-billion-dollar sales and significant growth potential, further diversifying Roche's revenues. Number 3, Roche and its innovative US arm Genentech have a solid history of generating blockbuster therapies in oncology, and Roche's pipeline is full of novel candidates candidates with a particularly large late-stage pipeline. Then for the key qualitative points supporting a potential short thesis for Roche. Number 1, competition in immuno-oncology is fierce, and there is no guarantee that Roche's core pipeline programs will be able to generate data superior to current treatment standards. Number 2, Roche relied on 3 cancer drugs, Ridazan, Avastin, and Herceptin to provide 32% of revenue in their fiscal 2019. Biosimilar launches for all 3 drugs in the United States have weighed on sales significantly since 2020. And number 3, Roche's immuno-oncology drug Tecentriq was launched 3rd to market behind Bristol Myers Squibb's Opdivo and Merck's Keytruda, raising questions about Roche's innovation. There you have it for a balanced view around the qualitative factors for this business. Now it's time for our final rating. In analyzing Roche Holding AG, stock ticker symbol ROG on the Swiss Stock Exchange, and RHHBY on their over-the-counter listing in the United States, we learned the business produces significantly above average returns on capital of about 36.5% annually. While they've grown their revenues and their net incomes modestly, their free cash flows are very slightly down. Their share buybacks outpace that decline, so the business has grown on a per-share basis. While they've taken on some debt in recent years, the business is still massively cash flow generative relative to their debt. On both a current and an average basis of their free cash flow to their enterprise value yield, it looks like Roche would be giving a potential attractive risk premium compared to the yield of the 10-year treasury. In the last 5 years, Roche has also supported a growing dividend, and they've maintained a modest dividend payout ratio compared to their free cash flows. When performing a discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations of Roche, if you were seeking a 15% rate of return, it looks like a potential fair intrinsic value for the business is around $23 per share. Roche was last at those levels in September of 2012. The most recently that their stock price got even near that was in June of 2018. This again massively outpaces how Roche has performed as a publicly listed business going back several decades. So you want to be patient here if you were to dig in and research the business. It's worth reiterating this analysis is not a buy or sell recommendation of any security. It's not financial advice. Before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. With all of the factors of our analysis in mind, it looks like Roche is a very strong candidate for further research. If you're interested in the business, I'd encourage you to dig in and learn more about the company. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Roche with me, and have a great day.